Hey, and welcome to another video here at Fiscal Voyage. I'm Felix, and today we're going to do a 5-minute stock analysis on China Petroleum and Chemical Corp. This company was suggested by Tony. Thank you, Tony, for watching my previous video and commenting and letting me know about this company. So we're going to do a 5-minute stock analysis of China Petroleum to determine if it's a buy, hold, or sell right now. One thing I like to do with these stock analysis videos is that I appreciate the comments you guys leave with the stock symbols and the company you like me to analyze, because I get to learn different companies that I'm not aware of. For example, this one, China Petroleum and Chemical Corp. Could be found in New York Stock Exchange as SNP. Is also known as Sin OPEC in Chinese, and is an oil and gas enterprise based in Beijing, China. It is listed in Hong Kong and also trades in Shanghai and New York Stock Exchange. It produces several biofuels such as biodiesel and green jet fuel from waste vegetable oils. It also produces ethanol. It has a parent company group. SNP Group is the world's largest oil refining, gas, and petrochemical conglomerate, headquartered in Shanghai District, Beijing. Its business include oil and gas exploration, refining, and marketing, production and sales of petrochemicals, chemical fibers, chemical fertilizers, and other chemical products, storage and pipeline transportation of crude oil and natural gas. All right, so let's look at the fundamental of the company. Revenue grew at a nice rate of 8.87% from 2009 to 2018. This year, revenue is going to be lower for fiscal year 19. So that should drop that compound rate. Net income grew at a rate of 0.32 as well, as revenue is slightly lower. Net income is going to be slightly lower as well for 2019. It has a good credit rating of A+, which is investment grade, and operating income in that time period came in at 0.87%. Okay, revenue for the past 5 years has decreased 0.57%. So that it should be negative for next year, because, like I said, revenue for fiscal 19 is much lower. However, earnings has been growing over the past 5 years with an average of 3.86%. The fundamentals continue. Last year they had a $7.61 adjusted earning for the fiscal year. Net margin came in at 2.18%, which is very low. But it is slightly higher than 2017, which came in at 2.17. Return on equity is at 8.73. Debt to cap is pretty good at 24%. Currently, the company has a very high dividend yield at 9.31%. That's very high, with actually a pretty good payout ratio of 80%. And they have a 5-year dividend yield average of 5.96, so you could get the company at almost double the yield. With the dividend growth, they don't have steady growth, but it has been growing with a 10-year compound annual rate of 10%, because they pay twice a year and it fluctuates. Last year came in at $8.62, where this year is coming in at $5.59 for the total. So it's much lower than last year, but I've seen this looking at the history of the company. They've done this before. So I'm predicting next year it should be higher, because earnings are going to be higher. So we'll see. 5-year growth rate is much higher at 16.92%. So for the fiscal year 2019, analysts expect a $6.54 earnings, and 2020 $6.91. This is, however, much lower than the 2018 earnings of $7.61, but it is picking up. I think the price was dropped tremendously because of the fiscal year expected earnings, but it looks like it's picking up. CFRA has a projected earning growth of 1%. However, even with this earning growth of 1% for the next 3 years, my dividend drill return model has a total projected return of over 10% at 10.1%. This return can be contributed by the dividend yield of over 9%. So most of your return is going to come from dividends. Currently, The company has a PE of 9.10 with a forward PE of 8.68, which is good. That's how I like to see the PE and current PE and forward PE. And they have a 5-year PE average of 13, so it's much lower than their 5-year earnings average. If we look at the fast graph, the black line represents the monthly closing price, the blue line is the normal PE, and the orange is the earnings with a PE multiple of 15. Like I mentioned, you could get the company at a PE of 9, so it's much lower than their normal PE average. So that means it's some undervaluation here. So if we look at the fair price screen here, Morningstar gives a fair price of 73, the fast graphs at 74, Yahoo 82, and my dividend discount analysis at $62. Averaging out the 4, we get a fair price of $73.18, and currently the company is at $60. So it's undervalued by 22%, which is much. I like to see company undervalued 10% or more, so this definitely fits that criteria. Therefore, I recommend it as a buy at current prices. I like the fact that the company is undervalued over 20%. Most of the projected return will be by dividends, however. I don't like the dividends are all over the place. You know, they only pay twice a year, and some years are lower than other years, but overall it has an uptrend. And I also prefer well-known oil majors like Chevron and Exxon than a Chinese oil company. But if you're looking to diversify, you know, with other countries, this is probably a good one here, and that's why I recommend it as a buy at current prices. Alright, so with that, you know, if you find this video informative, make sure to hit the like button and subscribe to my channel for more videos like this. And if you have a particular video you would like for me to analyze next, please leave a comment with the company name and the stock symbol so I could put it in my list. And also you can check my portfolio on my website, which there's a link in the description. Thanks again and have a great day.